Okay, those are our action items. Mr. O'Toole has a financial presentation for us this evening.
Good evening. I will try to make this quick.
It's important. You take your time.
This is a same financial where we ended the fiscal year for 23-24. The format, I use the same format as last year and the year before. I deleted a few slides out of there, but overall, the presentation will look rather common. Starting off with local revenue, again, the structure of the slideshow itself, as you'll see down the left-hand side, you'll see the actual categories. And then we have where we ended 23 or 22-23, our original budget for 23-24, and then where we ended the current fiscal year, the variance compared to the budget, the percentage variance, and then an explanation. So overall, just focus on some of the larger items, and you can see there at EIT, we had over $1 million surplus related to where we budgeted. Wage growth continues to grow. I'll show that here in a little bit more further of what the trends look like over the last 6 years. Real estate transfer taxes are down 184,000. Low inventory. Interest rates are pretty rather high. It slowed the market down. You're looking at delinquent taxes. We're up about $100,000 at some point. I expect the delinquent taxes to fall. I mean, we average about $1.2 million being sent to the county to collect, and somehow we've been collecting more. And then our AR over that time, our accounts receivable over that time has quickly declined to about 800,000 now. So I would expect to see some drastic reduction in that in the future. Our earnings on investment, our rates were higher. The Federal Reserve's maintained those rates a lot longer than what we expected. So that generated $355,000 in additional money. And then 542,000, 360,000 of that relates to our Edmund L. Thomas, which is basically the IU run program where they reimburse us a year back. We pay everything up front, and then they'll reimburse us after they bill out the tuition to the other school districts that have students in that program. Well, the last year we added LearnWell, which is for the residential or the hospitalization program out at LECOM. And so that makes up about 350,000 of that 542. 90,000 relates to bus patrol, which is the cameras and the citations that are issued. Shockingly, that's staggeringly high. I wouldn't have expected that to be as high, but hopefully as we move into this upcoming year, we have less citations, which would translate to being more safety for our students out on the road. So in total, it was about 2 million or 2.6%. So as we move over to state revenue, the basic ed formula was $657,000, as well as the special education school age formula was about 198, and the Ready to Learn grant down towards the bottom there was 300,000. That was all an increase in state allocation. According to our board policy, we budget at what last year's allocation was, and then we roll the current year allocation if it's above into our capital projects account. So you'll see that on the other side here that the capital projects was more than we expected. That's a primary driver of that is because of our board policy, how that sets it up. So this upcoming year, we would account for the additional state funding that we received. Our federal money, it was relatively flat for the most part. We've spent all of the federal relief funding. There is no longer, we took the remaining amount as we talked about probably in January-ish timeframe to our HVAC project for MIHS. So there is no more funding related to that. So if we take a look at this a little bit different way, just looking at a chart bar graph here, you have on the far left-hand side, it's 22-23, blues local, red state revenue, and then gray is federal or federal relief money. You can see in 22-23, we spent a lot more in federal relief funding. You can see where the budget is, our original budget, and then where we ended. And we were up about 2.8% from our original budget. And that relates to earned income tax, investment income, and state subsidies, as we just showed. If we could take a look at this over the course of time, you have on the far left-hand side here, it's 2018-19, and every fiscal year through 23-24. Again, 67% of our total budget's locally generated, followed by 30% state and 3% federal or federal relief funding. This is just showing a little bit different as we're sitting here. So large variance trend over time. I mentioned the earned income tax. We finished about $1 million more. And we talked about this when we were going through the budget, and we increased it about $1 million in this current year's budget. But you can see we were averaging about $7.5 million, and it's steadily increased. That's a sign of wage growth within Mill Creek. Real estate transfer, you can see that it's kind of volatile over the last several years. Delinquent tax is the same, investment income being the exact same, and then down towards the bottom you see state money and the increases that we steadily increased or have received, excuse me, over the last 6 years for our subsidies. So we flip over to the expenditure side here. This focuses on salaries. From an administrative salary standpoint, there was a $72,000 savings. We primarily operated without a director and an administrative officer position for most of the year. That was offset by us moving to 2 weeks behind. That did have a little bit of upfront costs, as we talked about at the beginning of the fiscal year. The teachers and the LOAs, those net each other out. Those are long-term subs. That the LOAs are the long-term subs that go in to fill, whether it's an open teaching position or a mid-year retirement. So those would really net themselves out as we're going forward. You can see extracurricular, 30,000. That we didn't fill some middle school extracurricular positions. 100 as we're looking at 181,000 for technical support. It's turnover. We held on to a few positions within the maintenance department before hiring. Into custodial and SSOs, $251,000 savings. We had a lot of number of custodial. There's a lot of turnover in our custodial positions. You can see that kind of nets itself out with the overtime down below, the 209, as we had the open positions, but we still needed to clean. So those were backfilled with overtime for the most part. So overall, our salaries are about $182,000 to the good, and we had about 1,251 unpaid days full-time, as well as 60 half-time days that were unpaid. If we look at from a benefit side, our life insurance and disability continues to increase drastically year over year. It's rather immaterial in the grand scheme of things, but from a percentage perspective, it's worth noting because that we continue to see that increase on an annual basis. Your FICA and your PSERs, we had a savings in salary, therefore you're going to have a savings in those. Those are both a percentage of salaries. You can see the big one here is healthcare. We've been very fortunate over the last 8 years, I would say, where we've been managing our healthcare increases to about 3 to 4%. Well, we had 12% this past year. We were trending rather well when we were going through presenting for the budget of this upcoming year, and the months of April, May, June, they were rather high. So again, we're self-insured. We pay our claims. We have a stop-loss insurance that limits our exposure, but there's no way of predicting this. It is just what the action of what has occurred from a claim standpoint. So that resulted in about $1.1 million over our budgeted amount for about 3.6%. If we flip on all of our other expenditures, you're looking at contract services of overspent by about $447,000. Most of that relates to our increase in sub rate that we had, that $336,000. The other remaining amounts is legal fees. I mean, some IU support contracts, our mental health contracts, etc. I'm going to flip down to transportation. We had savings of about $712,000. I think we all know we've been struggling for drivers. I mean, we would ideally like to have more drivers than we have. And then tuition, $580,000 savings. We actually finally are seeing a decrease that we've been expecting. It's 30 ADMs lower than our 3-year average. So that generated that savings there. And then you can see that we purchased some equipment rather than leasing it outright. And then, as I mentioned before, that between the equipment and the capital projects transfer. So we just look at a bar graph again, same concept as the revenue side. It's 2.1% over budget in total. that is primarily driven by healthcare costs, sabbatical projects, transfer, equipment purchases. And that equipment purchases is Chromebooks, laptops. We have those all on a cycle, and we always evaluate whether we lease or buy those outright on any given year. So just showing, again, the last 6 years from a bar graph standpoint, using those categories. The key off of this graph here is the salaries and benefits is 69% of our total budget. When you account for tuition and travel, and then our debt, you can see that our budgets, our actual expenditures are minimal in terms of what we control year in and year out, as most relate to contracts. So looking at expenditures, this is really looking at it from not from an expenditure account standpoint, but from a function, which is more or less department oriented. And the blue down below is our direct instruction. 57% of our total budget is spent on direct instruction. 9% of our total budget is spent on debt, with 34% spent on all other items. Again, this is just a bar or pie chart just showing that a little bit differently, where you can see a lion's share of our total expenditures is salaries and benefits. Again, we would expect that given service-oriented business model. So if we look at the waterfall graph, you have local revenue of just under 80 million, 36 million in state, 3 million in federal revenue, offset by salaries of 48, benefits of 33, other of 36. We ended with a $1.7 million surplus. $814,000 of that surplus is earmarked towards extracurricular facilities. That equates to like our advertising fees, our participation fees, 25% are of our investment income, which is based on a board motion that was approved several years back. So what's that look like for our fund balance? You can see where we ended. Up across the top, we have our unassigned fund balance, our non-spendable, which is like our prepayments, essentially, or an account for our supplies that we have on hand. You have our capital projects fund, our committed fund, as I just mentioned, that $814,000 goes to committed. You can see that sitting there. And then some of our assigned fund balance for salaries and benefits, as well as IT, given our total. So we had roughly 27 million, just under, as it relates to 22-23. We finished 1.5 million. We're looking at about 28.4 million. Our unassigned is 9.2 million, which aligns with our fund balance policy of being 8% of our total expenditures. Our non-spendable is really GASB driven year over year. Our capital projects fund is we transferred some of the money in, as we talked about, related to our state subsidies, offset by our security project that we had there. Our committed fund, as I just talked about, there was $814,000 went into there, and then you can see the difference as it relates to the other assigned areas. Moving over to the food service and child development funds here real quick, and these numbers are not reflective of OPEB and pension. Again, those were reported in the audit as full accrual, not modified accrual, which primarily difference is adding in the long-term pension liabilities as well as healthcare. But our food service fund operated at $353,000 surplus. We are going to be looking at the food service fund to see if we can use some of those money to offset some of the bond money that we've used related to food service equipment. And then we are reviewing CEP within that program, which means essentially all students are free for breakfast based on a state program. The CE program is a federal program that would make lunch free as well. So we continue to keep an eye on that. It might end up being where we might have several buildings being 100% free. But we'll continue to analyze that as we move further through the year. Child Development Fund operated at a $236,000 deficit. We presented those numbers pretty consistently as we went into the budget. We fully expected that outcome, and we'll continue to monitor that as we go throughout this fiscal year. So the last piece of this real quick to talk about is our bond funds. So you can see here, we had a 2020 through 2022 and 2024 bond issues. The amounts on the right-hand side, interest earned as of June 30th, projected interest as we have here based on cash flow. The $2.9 million is a little bit different because, as I mentioned several weeks ago or months, is we were awarded about $2.9 million grant in grant funding that related to the projects that we had earmarked for our bond money. So I added that to the revenue. Our federal relief funds, as we discussed earlier, Haas naming rights, we have about a total revenue of about 161 million. So we look at where we stand with our projects to date. I won't go through all these. We've talked about these a few times a year. You can see each individual area, but we have about 160 million already allocated. That includes about $640,000 in change orders that I put into the 2024 area. We are still waiting on hearing about grants related to our windows and exterior restoration. We did write some facility grants with the state. Hopefully we can get some money awarded related to those two areas. They were supposed to tell us the answer September 17th, but they pushed that to their October meeting. So we'll find out in October whether that occurs. But if we just look at revenue minus expenditures, we've got about $1 million. We didn't account for the change orders that we might have as it relates to the McDowell project, specifically with the library area. We are actually doing renovations, demoing, as well as the auditorium area. So that $1 million could be used up pretty quick, depending on what the contractors encounter when they're doing their demo work. But as it sits right now, we're sitting really well in terms of having enough money to get through all the projects that we had planned on. This is just a timeline. This is the same slides we've used in several other presentations, just trying to outline what we've done over the years. Anything from roof restorations. I mean, we're really mechanical, electrical, and plumbing to every building, our roofs, etc. Where we're going. So it takes us to forecasting out, and these are some assumptions. The forecast that we use projects a tax increase 3% annually. The index this past year was 6.4%. The index just came out last week. It's 6.4% for this upcoming year as well. Increase in EIT of 1% annually, of 1%, and then most other local revenue I increased by 3%. Our basic ed and special education subsidies I increased 2%, 2.8% annually. Salaries increased 3% annually. PSERS, I used the projected increase that the PSERS board provides. At the end, healthcare, I used 4%. You just saw we encountered 12%. That could be anywhere. I used our current debt schedule. We have no plans of issuing any more debt, so that number is rather static for us moving forward. Increase their sub account to max actuals or transportation. Increase that 4% annually. We'll know a lot more about that in the next couple of months as we move out to bid those services. And then I outlined a few items here. Obviously, a forecast that has a lot of assumptions built into it. There's a lot of moving parts. We're in with labor contracts, federal money, healthcare costs, etc. This could be changing at any moment in time. But as it sits right now, kind of taking a look at it, the far left-hand side, budget 2025, that's our current year budget. And then using those assumptions, just kind of forecasted this out. Overall, if you look at the surplus deficit area, I mean, we're within about $1 million and a half, over $130 million. That's not bad. And so this is just really showing that there's a way forward, minimal tax increases depending on it, but it also shows that we can't be everything to everybody, and we can't have a lot of massive projects coming forward that weren't planned. This is just showing this a little bit different. This is just what I just happened to say. Any questions?
Thank you for that. It's come out on the positive. I think the only thing really to stress is, the projection summary is a bunch of assumptions. I think where we're projected is outstanding because materially we are about 1 to 1.5 to the better because of the way we are conservative. So those numbers don't necessarily concern me as I look out to 2030. We are in a feel a very strong position to navigate this.
Sure.
Section 5, questions from the public. Are there any questions about any of the action items that we discussed this evening? Being none, take us to item 6, adjournment. I'd like to make a motion to adjourn. Can I have a second?
Second.
Any discussion? All in favor? Aye. President Winchell,